Hello and welcome to today's FX Times fundamental recap of the Forex market. I'm CMS Forex Market Analyst Nick Nassad. Today is Monday, November 30th, 2009. So today brought several developments in regards to the Dubai debt crisis that we saw at the end of last week and over the weekend. And these developments moved risk sentiment both up and down. First, we had the United Arab Emirates Central Bank say that it pledged to provide liquidity to local banks with exposure to debt, and that helped risk appetite, especially to start Sunday trading. However, overnight we had Dubai Finance Ministry officials say that Dubai World's liabilities are not guaranteed by the government, which increased risk aversion and helped to boost safe haven currencies like the greenback and yen. Then, in New York trading, in the New York late session, we had further news that Dubai World was seeking to negotiate about half of its debt. So that was a positive development, and that helped the euro and others to cut some of their earlier losses to the greenback. In fundamental news from the Eurozone, we saw the flash estimate of the CPI, where the annual rate rose into positive territory for the first time in 7 months. So we had a 0.6% increase, which beat forecasts. The coming months have the chance to see the annual CPI rate climb higher, as prices plummeted around this time last year, and as those monthly declines are taken out of the equation, the annual CPI should gain. Also, the Eurozone economy is beginning to gather some strength, which should increase inflationary pressures. Also, we're having commodity prices increase, such as oil, so that will also put an upward pressure on prices. In the US dollar Japanese yen pair, we saw a very sharp slide to end last week on the Dubai concerns, though we did have a pretty strong rally in late Friday trading. This week we opened up with the yen gaining strength against the greenback as well. In news from the Japanese economy, industrial production for the month of October rose 0.5% in October, according to preliminary data. This was a smaller increase than expected, as there was some cooling in demand from China. But overall, it's the 8th straight month that production has gained, and the future expectations part of the survey showed that Japanese manufacturers expect to increase production in both November and December. Now, a very strong yen could hurt production, as Japanese exports would then become more expensive abroad, and that could hamper export growth. Now, turning to the US, we saw the Chicago PMI come in better than expected for November, rising to 56.1 from 54.2 in October, which beat forecasts, and it's the second straight month that the Chicago PMIs have been above the 50 level. Now, this index is used sometimes as a leading indicator for the ISM manufacturing index, which comes out tomorrow and measures the entire US. But that the index increased is an encouraging sign for the economy. We can see that we were at very low levels to start this year, and we are now moving back into expansionary territory. The increase here was led by a very strong surge in new orders and deliveries, while unemployment, though improving, still remains quite low in recessionary territory at 41.9. In a look at the pound-dollar pair, we see that the pound was pressured in today's trading, as UK banks are some of the most exposed to the Dubai World debt. Following our counter rally Friday to our fall on Thursday and Friday, we saw the pressure on the UK pound return in today's trading. Those considerations dominated the pound's moves today, despite some mixed fundamental news. Which first, we had the GfK Consumer Confidence Survey for the month of November decline to -17, which surprised forecasts on the downside. The index shows that confidence in the general economy over the last 12 months has reversed by 6 points to -59, while the Major Purchases Index, which is the willingness of consumers to spend on large purchases, fell 7 points to -19. So kind of a gloomy report on the consumer confidence side. To follow up on those numbers, we saw that net consumer lending for the month of October was at £0.3 billion, which was lower than forecast and lower than the figure in September. Net mortgage lending rose by £0.9 billion, while net consumer credit fell by £0.6 billion. And that's the fourth straight month that consumer credit has declined. And it shows that consumers are much more willing right now to save as opposed to spend, and they're trying to pay down their debt instead of taking on new debt. The same report did show mortgage approvals climbing to their highest level in 1.5 years in October to 57.3 thousand, though that figure was lower than expectations. Finally, a measure of home prices in the UK rose by 0.2% in the month of November, which was the fourth consecutive increase in house prices, and it brought the year-on-year rate of growth to negative 2.9. So that's showing a steady improvement. The Australian dollar-US dollar pair traded mainly sideways today as its rise in the beginning of Sunday trading was cut down in overnight trading, and we did see a bit of stiffening in late New York trading. So this was sort of this general pattern in today's risk sentiment, and traders now await tonight's Reserve Bank of Australia interest rate meeting, where expectations are for an interest rate hike of 1/4 point. The case for interest rate hike was probably bolstered by the TDMI inflation gauge, which showed inflation rising 0.3% month over month for the month of November, which put the annual rate up to 2.1%, which is in the band that the RBA targets between 2 and 3%. In a weaker release, new home sales for the month of October were down 6% in Australia, which followed a 4.5% decrease from a surge that we saw in August. In a final release from Australia, the private sector credit growth for the month of October was flat, which disappointed forecasts and put the annual credit growth rate at 1.1%, which was also much lower than forecast and lower than in the previous month. For the third quarter, company operating profits were down 2.1%, which was a figure that disappointed forecasts, but was at least the slowest rate of decline in 4 quarters. Earnings at construction and manufacturers helped to offset a drop in profits at banks and retailers. And in our final look at our fundamental news, we turn to Canada, where the GDP for the third quarter in annualized terms was up 0.4%, which means that the economy exited its recession, though the increase was smaller than forecast. The rise came as we had a second consecutive quarterly gain in personal expenditures or consumer spending, and also the first expansion in business capital expenditure since the fourth quarter of 2007. On the month, GDP rose 0.4%. So Canada is unique in a way because they do put out monthly GDP figures, and those did meet expectations. The US dollar-Canadian dollar pair was, after opening lower in favor of the Canadian dollar, traded very sideways and choppy in most of today's trading, sticking to a pretty narrow range. Now let's take a look at some upcoming releases. As I mentioned, we have the Australian Central Bank deciding on interest rates, where they are expected to hike rates. We're also going to get building approval numbers from Australia. Overnight, Germany will post its retail sales and its unemployment change, while the UK will post another measure of housing prices from nationwide, though that is subject to change. Also, both Europe and the UK will post their manufacturing PMIs, and the Eurozone will post its unemployment rate. So a pretty busy day for Eurozone data. Tomorrow in the US, we get the ISM Manufacturing Index. As I mentioned, is the most important index on manufacturing activity in the US. And we're also going to have data on pending home sale. And that will wrap up today's fundamental market recap. And for more news and analysis and today's daily technical analysis recap video, please visit our site, fxtimes.com.